All right, let's get back into it. Good morning, I guess, depending where you are in the world. But been out of the market for 10 days, I needed a break, and I think it's time for me now to get back into it a little bit. So let's have a look at some charts. Uh, Probably next week I will try to look for a few setups to, you know, get my feet wet once again, slowly, hopefully. And I thought, there was something I wanted to put out. It's really interesting, might be controversial, and some would say even on the provoking side of things, if you wish. But I wanted to start out with this. Okay, now you may wonder, what was that? Well, it's just a chart, and there is a very clean and defined setup on it. As you can see, you got the usual low formed, low rated, and then your shift in market structure and price, you know, marching back up. Then you have what? Well, you have this area which has never been retested, and you can actually draw in it using bodies over wicks in these, you know, occasion, and you can notice that there is this kind of a gap, if you wish, in here, some sort of an efficient delivery to the upside, and then you have this point of release, if you want, where price really starts to accelerate to the upside, going to break structure in here. Now, the point for me would be, if I throw a fib on it and if I try to measure the midpoint of this point of interest, this area of interest, I see it lines up pretty perfectly with this inefficiency right in here. Okay, so my idea was looking at it back now. Looking at it right now. I can say, yeah, that would be a setup that I consider, valid. It is a valid setup, and it is something that I would like to trade. Now, of course, given my standards and given my strategy, I would place my stop below the week low right in here, not necessarily at the gray area, right? Just to add a little bit of a buffer in case we got a much more volatile move, which could actually stop you out if you are a little bit greedy with your stop placement, right? Just to give it a little bit of a room to breathe. And I highlighted in blue these areas right in here as take profits area. The feel of this inefficient move to the downside, or this relatively equal highs right in here, and again another inefficient moves down. It could be rebalanced, and ultimately these pocket of price action right in here. So respectively would be 2.4R, 3.75R, and 5.25R. So not bad. Of course, this is all hindsight. It doesn't mean that it could have played out differently, right? So it's not guaranteed, but at least it sounds like a very logical and fairly calculated plan. You got, your trigger, you know what you want to see, and you know that you already seen it. You have your chance to actually go there and buy it, and you have clear and defined targets, right? So why not? Would you take this trade? Yeah, I mean, why not? It is a trade I would take every single day on every single time frame, because now, of course, in the screenshot we are not seeing the ticker, we are not seeing the time frame, we are not seeing prices. There is a reason for that. I'm going to explain you, but essentially just focusing on price behaviors. Would you take this trade? And the answer for me would be, yeah, I would. Okay, because I'm seeing everything I need to see. Okay, so this is a valid setup for me. Now, let's try to unveil a little bit more of this trade. Let's get back to the original chart, which is this one. So of course, as you can see, this is Bitcoin, all right? And well, we don't need to discuss about price levels or whatnot. We know where we are and we know what's going on. But there was something that really caught my attention looking back at it, because no matter how you think about the setup, and as I was saying, I think this is a valid setup, but what really hit me in the face was the timing of it. You got this impulsive move down, and this candle, that this is a 4-hour chart, of course, but that was essentially when the Russian invasion of Ukraine was starting, because it was this down move was happening in between 1 a.m., 5 p.m. So that was the morning, at least, considering my local time, where Russia were actually initiating the invasion of Ukraine. Now, I wanted to highlight this point because I think it's a very good point of conversation and discussion, which is essentially your trading plan versus, or as an opposing view of what's going on in the broad market. So let's say you wake up in the morning, you see something like this which is going on, a trading setup, an opportunity for you to buy, which is actually unfolding itself, and then let's say you turn on the TV, you watch the news, and you think, maybe, I'm not saying you should, but maybe you think, wait, uh, what's going on? I mean, it is bad. Will the market gonna react in a very particular way? Will it be different? Will it be nervous? Will it be panic? What's gonna be? Should I still take this trade or should I cancel it? I mean, you know what I mean? It's a nice topic because I've seen a lot of times, not only other people, but me as well, myself included, especially back in the days. I tend to do it a little bit less nowadays, but still, sometimes it happens to me as well, even now. You got that, situation where, although you think a trade or a setup, it's fairly calculated and well thought, and you have all the reasons to get in and to engage the market, but all of a sudden there is something in the outside world which actually leads you into, you know, cancel the trade, pull the order, okay? Usually the reasoning behind it, it's like what you could have in every particular news event, okay? It's kind of the same of what I see people do, like in the FX market. Let's say we are approaching a particular relevant moment on the economic calendar. It could be FOMC or NFP or an interest rates announcement or what have you, or other data release points which are actually impactful for the market. And you see these guys that are actually going, yeah, it was a good trade, it was a good setup, but now I don't want to take it because I might expect volatility to spike up. Maybe liquidity is going to go dry a little bit because of the news, and I don't want to take the chance. Okay, so I'm gonna pull the order, and I'm sure as I'm thinking this, other guys are thinking the same, and it's some sort of a self-reinforcing behavior. So I got even more reasons to pull my order, right? But the controversial or provoking question I wanted to put out is: are you doing it because you think it's the best thing for you to do, or are you doing it because you just read online on forums or in books that you should do it? Because although it's kind of a nuanced thing and a nuanced topic, the implications can be very huge for yourself as a trader. My take on that would be, if you are doing it, let's say you are canceling the order because it is in your best interest, then you should go ahead and cancel it and pull it, okay? But I would say, and I would expand a little bit on it, if you are doing it just because other people are telling you to do it, or just because other people are telling you that that's what they do, I think that's the wrong decisions to make. I mean, right or wrong, it depends because it is all relative. But I would say at least it's a decision which is not based on information that you have firsthand, or at least experience that you have firsthand. So what I would say would be, instead of trusting what other people are telling you, or instead of trusting whatever maybe you have read on forums, why don't you go back in time and actually backtest the stuff? You know. Now, I'm not saying you should backtest what's going on in the market when a war actually start out, because well, that would be brutal, right? It's like, would you backtest something like a war beginning every single month? For fuck's sake, if we had a war every single month, we would be completely fucked as a species. But anyway, you get the point. take these news events, right? As I was saying before, NFP, FOMC, whatever, and just go back in time and see how price responded around those moments. Because at that point, right, you could have all the answers you need in order to decide if it's in your best interest to pull an order or to stick to your gun and execute your plan. Because you would, of course, with the benefit of hindsight, yeah, but you would have a statistical sample which should tell you black and white if in those moments is in your best interest to commit to the position, to stick to your plan rather than pull it. And I mean that's the answer you need in order to have an adamant behavior and deciding if you want to stay there in front of a market and saying, you know what, I don't give a fuck if you're plunging into this level. I don't give a fuck about the volatility spiking up because I know that, over the last 100 occurrences, these setup have worked like 75 times. So I'm gonna take it every single time, because it gives me a statistical advantage in the long run. It gives me an edge. So at the end of the day, I think the discussion should be, are you actually trading the market? Are you trading your edge? Or are you trading your sentiment or your thoughts or your feelings about what's going on? Or, what other people are telling you in that moment, or what the news are telling you in that moment, what the TV is telling you in that moment. Yeah, I mean, it is a little bit of a net wrecker, I get it, because you got what is a very bad news, not only for the markets, but for the humanity in general. And I get the point is that you tend to be carried away. Maybe you should think, yeah, the setup is good, but fuck, this is a war. So the market's going to react very, very badly, and probably it's going to plunge because everyone is going to, let's say, scramble for the door because they don't want to be exposed, they don't like the uncertainty, and I'm not going to take this trade. But guess what? I mean, it would have worked out perfectly for you. Now, I don't need to tell you where to take profit on a setup like this. It's completely fine, I guess, if you collapse the trade entirely up in here. It's still a 2.5R. It's not bad. It's a very nice trade, okay? I'm just trying to put out this opposing view, if you wish, and to give a little bit of a topic of discussion, and you should really reflect on it, I think, because for me personally, I do remember that I was always like, yeah, you know what, I'm not gonna trade New York session because I know there are news coming out and I don't want to be involved. I rather step on the side and watching from afar. And I had a few people telling me, yeah, dude, you know what? I mean, if you don't want to engage, it's all fine. It's a personal decision. But are you doing it because you think you shouldn't do it? Or, I mean, are you doing it because you know for a fact and you have data supporting your thesis that your edge is not going to work good enough in these market conditions, right? Because at the end of the day, right, price action is price action and price is price is price. So if you have solid evidences that you shouldn't engage the market around, data release point, it's all fair and good for you not to engage. But if you are doing it just because you think, keyword, you assume is the right thing to do, well, maybe you should reconsider and go there and verify the facts. That would be in your best interest, taking decisions which are based on numbers and not on, the heat of the moment or personal feelings or even the trust that you put in other people's opinion. Okay, so I thought it was a good point to bring on. And of course, this is just a single example. It doesn't mean that every time there are news hitting the market, you're gonna have the same type of reaction. I'm just saying if you have an edge and if you know this edge is working for you over time, are you willing to ditch it just because of a feeling you are having here and now in this particular moment, which is driven by a lot of stuff, but you don't really know for a fact what kind of impact they can have on the market. Again, unless you have actually back tested all the similar situations, back in time. All right, that was my point. I hope it's I hope it is a good point to to put some thoughts on, because it might help you. For me, I found that since I started trading, news release like NFP and FOMC, for instance, I found the numbers tell me that those moments are particularly profitable for me, and I can really take advantage of the volatility spikes. And again, it is some sort of a controversial topic, and it is very counterintuitive, because for you as a trader, what do you need in order to actually make money, to be able to take positions, to ride positions, right? Well, you need volatility. You need price to move from one point to the other, because if price just gets stuck in a very tiny range, it would be very hard for you to make any decent amount of money, right? But on the other hand, although you need volatility in order to profit from the market, when you actually get volatility, you kind of step back a little bit and you think, oh, maybe volatility is a little bit too high. I might want to stay on the sideline and come back later. So you need to find a balance in between the two, because you cannot have it both ways. Okay. So just some thought. That being said, let's have a look at what happened in Bitcoin recently. I think the very short answer would be nothing on a higher time frame base. We are still in here. We have been in this range and we have been stuck in between these two areas for quite a long time now. So nothing really changed on a higher time frame level. Sure, looking at this weekly candle right here, of course it's not closed yet, but I mean it doesn't look like it's really shaping up good for the bulls. But you never know. You never know up until the point it's closed. I always wait for candle close to have confirmation. Let's take a look at the daily and let's see if we have a different story, or if we can grasp other stuff. Well, I don't know. I think I'm still retaining my bearish bias. It's been like that for ages now, but well, all in all, it's just a trading range the way I see it. We are still trading in between those extremes at around 45 and 34, something like that. Yeah, we had this swing failure pattern right in here on the daily. Again, that was the day when I guess the war began. And after picking up liquidity in here, we basically traded up above this level right here, and that liquidity collected in here was distributed above this high in the same area. So it looks like we're still finding a decent amount of sellers up here and a decent amount of buyers down here. So still a trading range. Now, just a very quick thought on trading ranges. When you have a trading range like this, you should try, or at least I usually try to go and look and identify the extremes of the range. So in this instance right in here, I use bodies over wicks again. So you can try to go and find, your range low and your range high. And usually I've noticed if the equilibrium, the midpoint of it, actually lines up with, some areas where you got reaction, or at least you see that price is manifesting particular behaviors around that point, there is a very good chance that you drew the range correctly. Okay. And what I do like to do in these situations is not trading inside the range. I would prefer to see price getting, around extremes, and the best thing would be having deviation outside the range, and then price, coming back into it, and you can trade the return to the deviation and targeting the midpoint, the fair value of it, if you wish. Or it's not my favorite thing to do, honestly, but you could take the midpoint of the range as a reference point, and like in this example right in here, You have it tested from the upside, then you have a break, a retest from the opposite side, and continuation. You could try to go short in here, maybe placing a stop about this level, targeting these lows right in here. That could be another idea for range trading. But quite honestly, I do prefer to trade the range when price actually approaches extremes. Not only because it's much more easier to manage risk, but you're actually increasing your risk reward as well. So, as for the rest, yeah, we had this impulsive move up, and now we are getting back in this pocket of liquidity. We are actually testing this point of release right now. I mean, this is a 4 hour. It's gonna close in 33 minutes, so not a good reaction yet. I mean, usually point of release should give you almost an immediate reaction. We are not getting it, so you know, could be that we are gonna test the low side of the range once again. Who knows? I guess we just need to wait and see for that. Other than that, I mean, there is nothing really particular to be said about Bitcoin right now. I think still in this trading range, and up until the point you start to see areas like these or these being cracked, it's gonna stay in this range again. So I mean, the range is the range up until the range it's there. It's like the trend. The trend is your friend until the end of the trend. Guess you could say the same about consolidations or range bound environments, right? So yeah, I think I already made my big point of conversation for the week. Uh, there is nothing more I'd like to say about this price action in here. It's pretty straightforward, I guess. So yeah, try to try to think about what I've said in the beginning of the video, and we probably get back to Bitcoin next week and see if we have some further development in context with the surrounding environment around the globe. There are a lot of stuff going on. So all of a sudden, this consolidation could really start to get volatile, and we could see a breakout or breakdown of this consolidation. I think at that point it's going to be pretty violent. But up until the point you don't have it, you know, cannot trade if it's not there. So just be patient. And with that, I'll leave you off. Have a good weekend and a good start of your week tomorrow. Peace out.